You're going to want to pay extra close attention to this episode of the Thinks Wall Street Can Think. We talk about divergent behavior and megaphone tops.
Yeah, all right. So this is what I wanted to talk about is one of the biggest questions that we're getting right now as we're doing our client reviews for the end of the quarter is how much further can this stock market go? Because the savvy, more experienced investors that have been around investing for 20 or 30 years, they know things don't always last or can't last forever. So that tends to be one of the big questions that we've been getting, along with, hey, what's going on with interest rates and should we expect them to go higher? And all these things, that the questions that are being asked have caused me to really dig into the charts. And as I dug into the charts to share what I'm seeing in the markets with clients, it just really started to become, this is some important stuff that everybody else should probably know too, because one of the things that we want to talk about is you hear these things in the news is divergent behavior, or what we call divergence. And divergence is essentially where you have two things that are possibly running parallel, or they're correlating together in some fashion, and then all of a sudden one starts to peel away and diverge away from that typical behavior. And why that's important, and I think people are going to see and hear that word divergence and stock market divergence a lot more, is because we're starting to see some behavior in markets that you typically see at market tops, or when liquidity in markets is getting stretched and there's not enough liquidity to necessarily push all boats higher. Because how things stay correlated, how they stay parallel and kind of moving together, is there's enough capital supplying to all those vehicles to move higher. And divergence gets caused when there's not enough capital to push all those boats higher. So we see this in the charts, and I'm hoping that I'll be able to explain and annotate a few things in real time to get the point across as we've been explaining it to our clients. And one of the things that we're starting to see, and it's really important to understand, is when the fast, what you'd call hot money, or the risk-taking money, when they're feeling frisky and they feel that there's enough liquidity in the market and enough reward for the risk that they take, they tend to overweight places like corporate bonds. So I showed a chart here of the JNK, or the high yield corporate bond index, over the last 12 months. And then what also risk takers really like to do is they like to take risk in the small caps. So we've got the Russell 2000, or the small cap index, and then on the far right, the S&P 500. And what I really want to point out here is that you'll see that right here, between, I'll just make a little mark right there, which is essentially the middle of February, we see that the corporate bond market, which has been behaving quite well over the last year since the COVID bottom, has started to roll over. And when you look over here at the S&P 500, in that same time frame, from the middle of February to where we are in this month, you see a divergence in the behavior, where you have this starting to possibly lead lower, while the S&P 500, which is a broader index and has other components in it like financials and such as that, have been possibly holding that index up higher a little bit longer. And along with that, you have the Russell 2000, which was leading, but now really starts to look like it's showing more relative strength in that little to the downside in that little dip than you see here in the S&P 500. So they're very subtle divergences. And if I were to do the same thing and just bring it over to the Nasdaq, let me get my system working here. There we go. So if we take it one more step, and we swap out the Russell 2000 for the Nasdaq, then you see that divergence behavior even more. And it's really interesting because in the old days, we always really watched the Russell 2000 for risk taking. But in the last year, with the COVID trade being so tech heavy, and with Tesla really leading a lot of that higher, what we've started to see is in this divergent behavior, which I think is even more interesting and is going to frustrate, or has been frustrating, some investors that are heavy in tech over the last 2 months, is you have the high yield bond market making a high in February. You have the Nasdaq making a high in February, and now you have the S&P with a new all-time high here in March. And so this is really classic divergent behavior that should get people's antennas up, because if this continues, and now what you do as an investor, you really watch the Nasdaq and the corporate bond market, because if there is a larger market correction ahead of us, it's most likely going to be these assets that'll lead it. So what I would watch for is that if the Nasdaq were to really start to break down below these previous pivots, then we're going to have to assume there that we're going to have a deeper correction in the market, and equity investors are going to want to be very very cautious about what they're doing. And the reason you want to be more cautious now than maybe 5 years ago or 3 years ago or even 2 years ago is because we're really at a different time. And along with these divergences, one of the things that's starting to happen is this view of a possibility of what I call a megaphone top. And everybody is probably familiar with what a megaphone is over here on the left. But a megaphone top is somewhat of an example here. It's a very odd megaphone top looking, but nonetheless, you have this very long-term chart of the Dow Jones, and you essentially, since the COVID low of last year, you've got this skyrocket in all indexes that have just gotten wedged into this point, that usually it's a decision-making point or a point of inflection. And so I wouldn't be too surprised as if over the next few weeks that some of the volatility starts to increase in the markets. And if you're an equity investor, especially if you're an equity investor that's been late to the game, like you just got involved recently, you're going to want to be really careful and be really attentive to what's going on next. So that was, what I've been trying to share with everybody, Justin, as much as I can, and I thought was important.
Yeah, could you bring up those the other charts again?
Yeah, absolutely. So I think this shows you the best really behavior. I mean, between high yield.
Oh, go ahead.
Yeah, go ahead.
I mean, with the when you look at the Nasdaq, like you said, back in February, that high, and then you see just that kind of that sharp sell-off, whereas the S&P had a much short, it wasn't so severe, but came back a lot stronger in the same time frame.
Yeah, and one thing that's been happening for a while, and you see it in these charts, is that you can see where investors have now started to broaden out where they're putting money. And that's what I mean by not enough liquidity to push all the boats higher. And so while a lot of people were chasing Amazon, Google, Tesla for quite some time, and the market was getting very narrow, what's happened that you could see from the previous chart of the Russell 2000 is in the last 6 months, the market really broadened out, and investors started spreading their money to not just the Zooms and the technology companies that they knew COVID and lockdown was benefiting, but they were starting to position for the next phase, which is, hey, the economy is going to open up, and started spreading their money out. And with the increase in interest rates, you've seen a lot of people also go into the financials or banks, which is, I think what's happening is you just have not enough capital to push all these things higher. And so that's usually the sign that investors should take heed that if you're looking to buy something today, you might want to be careful, and do those purchases in stages as opposed to all at once.
So what are your thoughts on, everybody getting their stimulus check and, roughly 50 or 60% of, people in my generation are, wanting to put, that money into their trading account, your generation wanting to put maybe 25%, and even the older generation, the baby boomers wanting to put maybe 10 or 15. Do you think that that would have any type of, would change these patterns a little bit?
Well, I think that I don't think the market's done right here. I think the market is, going to struggle and stretch itself as much as it can. Over the last week, I've seen a lot of articles out there talking about, oh, the market's doomed, it's topping, it's this, that, the other thing. And one thing that I've learned a long time ago is that when everybody expects something in the market, it never happens. So I would, the market loves to create maximum frustration to the maximum number of participants. So if that were the case, I would do what we've done the last few days, get people a little sketchy, have some declines, and then go make new all-time highs and kind of get squeezed out there and get people chasing it and get that fear of missing out really going. And so I think that's where people, depending upon their age and when they need the money and how far away they are from using it, there's a lot of factors that you have to take in consideration, because if you're somebody who's been invested for 20 years and you've got a lot of profit to give back, you may not be so concerned. It's the people that are late to the game. It's the ones that are getting their stimulus check right now and they go to put it to work. They should be careful. I don't think that it changes the patterns any more than what's going to happen anyway. It's just more about what do they do, so that way in a year or two from now, they're not regretting the decision that they made. And so there's just techniques that you should use when you're starting to buy risk assets when they're at extended prices like they are. And that first thing is never buy everything all at once. If you're thinking you want to put it, if you get a $1,400 check and you want to just put the whole $1,400 in the market all at once, don't. Right? Just don't. Put $400 in, and then wait a while and put another $400 and do it thoughtfully. And so that would be the thing that I would tell people is this is just not a time to throw. It's not a time to be complacent if you've been invested a long time. And it's not a time just to think that you're going to make a fortune by buying anything, because when the tides change, they do change very, very quickly. And for the people that I think it's most concerning for is people that are maybe looking to retire this year or next year. So if you're within 5 years of retirement, or you've retired in the last 5 years, then I think this is the time that you've got to be really looking and doing your homework and studying your portfolio for where your risks are and what you're going to do if the tides change.
Yeah, so two things. First is if you take a look down here at the bottom, all of the relative strength on each one of these, and you can see how, you talked about trend lines before and in some of the divergence that's happening, but you can even see that, there is a decline, even though the market has continued to grind higher in the relative strength, in all three categories here, all three indexes.
Yeah, that's a good point. You bring up a good point. So you can see here where the market made a high, or the high yield bond market has been really, since the end of last year, from a relative strength standpoint, been weakening. The Nasdaq really has been weakening since September, since this last little burst and peak. So that's very interesting. And then you've got the same thing here in the S&P 500. So again, just another sign, another indicator that people should be cautious is really just what it is. And it's a time to have a strategy. This is, there's certain times where you can just sit in the market and be complacent, and then there's other times that you can't. So you were just at one of those times that people need to be asking questions as far as what they should be doing with their risk taking and what's the right way to do it. And when you get your stimulus check, think twice before you start chasing too many things right at this particular moment. So that's, that's what I got for everybody. What else? You got anything else you want to add?
Maybe one last thing is
Sure.
so like, let's say if I'm a person that's coming up to potentially retirement, and right now my portfolio is sitting at, call it a 70-30 mix between 30% bonds, 70% equities, and I'm maybe, let's call it 6 months to a year away from retirement. How would you say that, based on what you've seen and the things that we've just talked about, what would be kind of that rebalancing that you'd look at?
I wouldn't be overall concerned in that. I mean, if they've got 70% bonds, you got to look at what that bonds is, right?
Oh, I'm sorry, I said 70% equities, 30% bonds.
Okay, so if somebody's heavily, like, more weighted towards equities and their bond portfolio is 30% or less, and they're close to needing their money, or they're close to a catalyst like retirement, yeah, then right, this is the time that they need to be looking at that and thinking to themselves, okay, what if, what if you hit a period of time, and in this chart it's not that intimidating, but it happened for a period of time, is you can get a 10-year period of time where you have like a lost decade, like we had from 2000 to 2010, where if you were late to the game, if you're late to the Nasdaq during the dot-com era, you waited 13, 14 years in some cases to come back to even. So in that particular situation where you have somebody who's 70% equity, 30% bonds, and they're a year away from a catalyst like retirement, they really should be doing their homework right now of, hey, how do I hedge or reduce that stock market exposure? And I know a lot of people are like, yeah, but what, I won't make as much. And sometimes it's more focusing on, hey, what's ahead of you? Like, if retirement's right around the corner, it's about keeping the bird in the hand as opposed to chasing the two in the bush.
Yeah, and be careful of FOMO.
Yeah, FOMO's fear of missing out is very, very powerful, especially when your next door neighbor that you've already deemed is not nearly as smart as you starts telling you about how much money they made in XYZ. And there's a lot of that going around. There's a lot of interesting people running around telling people how great they are about making money, but they've never lived through making money during a lost decade like we did from 2000 to 2013. And it's a completely different way of investing than what you're seeing right now. So it's a very good time for people to start to beef up on their education. And it's a horrible time to be complacent with your portfolio right now. So
I totally agree, 100%.
well, good. Well, that's, essentially like we always say, if, with equity markets near all-time highs, should you be concerned? Should you be excited? That's different for everybody based on where they're at and the circumstances they're at. At the end of the day, what our job is to help give you guidance that if you have questions about the risk taking you should be taking at this particular point in the market, reach out to us and visit us at quiverfinancial.com. We're happy to help. We're happy to share any of the knowledge that we have over the last 20 plus years of managing money, so take advantage of it.
Yeah, and if you guys like the video, please subscribe and also give us a thumbs up or a like. Always appreciate that.
Take care.